But I buy a stock for an intended 20-year holding period. So I don't get kind of, as some Americans would say, bent out of shape by this week. In fact, I'd prefer if companies switch to a 12-month reporting cycle. Every 12 weeks is farcical. It's the single metric as measured by Morgan Stanley and Boston Consulting Group as the greatest driver of long-term stock price appreciation.
Hi there and welcome to Stock Club. I'm Mike and joining me today's episode is MyWallSt's chief investor Emmett Savage. Every month here at MyWallSt we publish our Stock of the Month in our Invest Plus service. Stock of the Month has an unbeaten track history of success. It's up about 5x since we started the service compared to the S&P 500, which is up about 2 times that. So doing pretty well so far. Not only that, but with Invest Plus you also get our 10 foundational stocks in there, a library of 60 stocks and growing, your weekly Charging Fearless newsletter, and if you have any room left, we're also including a bonus wildcard report on top of that as well. So for our loyal Stock Club listeners, you can get $50 off this bundle with the promo code StockClub50. That's StockClub50 in all caps. Just stick in StockClub50 all caps at checkout. Today's podcast brought to you by Vodafone Business. If you like us here at MyWallSt, you know that running a business is difficult. There are countless things to think about. Many often simply get ignored or completely forgotten about. Well, that's where Vodafone Business can help. They've crafted a suite of tools and supports to boost your business's operations. The best part is it's free for everyone, from cybersecurity to harnessing the power of AI, building a website and improving how your teams work remotely. Vodafone Business will help you address the often overlooked but crucial elements for your business's success. To get started today, check out their one-to-one VHub digital support and advice service. You'll find everything you need right there. Find the link in our show notes or simply just Google Vodafone VHub for more details. Now, let's get into today's episode. Emmett, how are we doing?
How are you, Mike?
I want to compliment your new background.
Thank you very much.
All your fancy, interesting books that you claim to have read behind you.
Well, actually, for our listeners, I'm about to bring about 4 big bags of books down to NCBI. I'll probably drive to Dunleary and throw them in there. And there's a whole load of investing books going into the charity shop this week. Well, actually, they're less investing. They're ones like day trading and strategies for day trading. I bought an absolute stack of them about 20 years ago. And they're all hardcover. So they're kind of trying to impute this kind of gravitas in the investing circuit. And they're very mathematical and you can get lost in all the whole pursuit of trying to make a life out of day trading. But the net bottom line is I still have to meet somebody who is day trading accurately, or at least with consistency, and making a living out of it. I know people who are professional gamblers in Vegas and they're making a living out of it, but I haven't really met anyone who said, yeah, I'm a day trader. It's all I do. I make a good living from it. I'm sure they're out there. But anyway, net bottom line is I'm giving away tons and tons of books this week, all to make the back the shelf behind me look a little more zen. And I had some specialist.
Nice and sleek.
Yeah, I had some specialist help from home here because I was in a frame of mind. Sure, it's grand. There's nothing wrong with it. But that is absolutely not the right answer. That's the right answer.
Yeah, the people making money from day trading are all on my Instagram selling courses. So I wonder if they're making so much money day trading, why they have time to go sell courses instead. But we won't get into that. But if you think about the people who are actually making money day trading, it's like Citadel and Renaissance Technologies and these companies that are having 1 million bets every day, and 500,050 of them come off, and that's how they make money.
Yeah, and plus it's formulaic. You're right, they have 1 million bets, or they have millions of dollars on a single bet. They issue a report very much in the favor of the direction in which they want stock to move, and then they sell, or they play into their own advice, or front run the advice, which is an illegal activity in certain conditions, but I am not here to offer any legal advice in that manner.
The humble day trader in their office with 6 screens is up against it now, if that's what you have to do to make money day trading. So, well,
the other thing, sorry, just before we beat that point to that, just one other thing is when you do find a trading formula that works, it serves you to tell nobody, because the minute it's out there, it becomes inefficient. So there are definitely day traders who have figured something, but they ain't not telling anyone.
Okay, this podcast is not about day trading, but we are talking probably a bit more short-termism maybe than we like to eschew normally on this podcast. Usually we kind of say just buy and hold for as long as you possibly can, really. One, I suppose, common theme, certainly me and you have to look at, is earnings season. So this week, 178 of the S&P 500 companies are reporting. So I just thought it'd be a good exercise to do a bit of a kind of quick fire round on someone who's seen, I don't know, maybe 100 earnings seasons in their investing career. Would that be a fair summation?
Let me think. So 25 times, yeah, 100, exactly. 4 quarters a year, 25 years, 100 of them, yeah.
So I just thought it'd be a good exercise to kind of do a bit of a quick fire round on some common questions our listeners might have around earnings season. So does that sound good to you, Evan?
Yeah, sounds good.
Okay, so the first one is just very general. Best advice you have received or you come up with yourself around tackling a busier earnings season?
Well, the best advice, I suppose, is it requires us to come back to the very maths you touched on there, which was I've lived, if you like, through 100 earnings seasons, probably more. But if you own 20 stocks, which I regard as the absolute minimum you should own, for a minimum of, let's just say 12 years, which I also believe is the shortest time frame you should consider. Well, that means you're going to encounter 20 times 12 times 4 reports per year, which equals 960 reports for your 20 stocks over the course of 12 years. But in reality, you're going to live through thousands of reports for companies you own, because 12 years is very back-ended. People usually invest for 20, 30, 40 years. They usually own more than 20 stocks at any one time. But we're talking about you're going to live through thousands of reports. So my advice is to understand your own level of interest in the sport. There's people like us, Mike, in the business who'll dive into hundreds of these reports to varying degrees. And we follow some of them, and some of them follow us, and there's those who are totally into it. But just know there's a lot of people out there who've had an incredible 30 years of investing, and they never even heard of an earnings season. They don't even know what it is. If you said, how are you going to handle this earnings season? They go, what's that now? So, it's all about knowing yourself. How much of the sport do you want to participate in? There's those who watch the Premiership every year and are happy to watch those 20 teams battle it out. And there's those who know every single statistic about every player and manager on that pitch since the Premiership was formed. And it doesn't mean one enjoys it more than the other. It's just how deep do you want to go?
I think that's a great take. All right. So this is just a general question. Why do companies report after hours or even before the market opens in certain circumstances?
Yeah, there's 3 reasons. Number 1 is to manage volatility. The second, actually, the same point, I think. I'm going to reskin the same point 3 times. There's manage volatility, avoid knee-jerk reactions, and basically allow news to be absorbed. That doesn't mean that it's always successful, because we always see at market open or market close after hours trading, you can see how the after hours market has responded to the news at hand, which doesn't usually translate to when the market opens, but you can kind of get a quick read on what was said in a conference call by looking at the color, red or green, of the graph of the stock and being reported. But it's really there just to manage volatility and as I said, to allow for whatever the CEO or her team or the CFO, whoever said, whatever they've said, to just be absorbed and taken on board by the listening public.
Yeah, I always think it's funny to see the algorithmic trading play out in the first, say, 5 minutes. So say the results come out at between 4 and 405. It's like up, down, up, down, up, down, because whatever kind of AI or technology they have to parse the data, it kind of just latches onto something, makes a big trade on that, realizes it's wrong, sells, and it's like up and down and up and down. So if that was happening in the open market with all the retail investors as well, it could cause a lot of hassle. Okay, your favorite metrics to track when reading an earnings report, and do they have to be the same across companies?
Well, to that one, no way. I mean, every company has its own nuances. It has its own specific industry or even company specific number that really matters. But the OG, the original gangster of numbers to watch is revenue growth. It's the single metric as measured by Morgan Stanley and Boston Consulting Group as the greatest driver of long-term stock price appreciation. Bit of a tongue twister, but the more revenue is growing quarter after quarter and year after year, the higher the likelihood that the share price will follow eventually.
Bringing it to this earnings season specifically now, is there any company in particular you're waiting to see the results of for whatever reason?
Yeah, there's two. There's a lot of them, as you said. There's a long shopping list, but I'm quite interested in Teladoc, which is today, Thursday, April 25th, specifically because they ousted their CEO quite recently, I think, as we discussed on a recent podcast. Actually, my conversations with people on podcasts are blending into one. I think we discussed on the podcast. So they're reporting today, and I'd like to hear how they're, let's say, tuning the business story prior to the new CEO's arrival. And I think they'll start to augment the story somewhat. So I'm just keen to see what happens there as a shareholder, as someone invested near the highs, as someone who in the peak of coronavirus got caught up on the story. I'm very keen to see how it all plays out. The second one, which I suppose I'm more looking forward to, is this coming Tuesday, which is Lemonade. I think are they after hours? I think they're after the market closes.
I assume so, yeah.
So Lemonade this Tuesday.
Okay, and then earnings season as a whole usually takes on certain themes. So obviously the pandemic was a big one, and then we had this big pull forward that came after that, and tough macro conditions were there for 2022. And then obviously AI has been the mainstay since. And we talked about, was it Sherwin-Williams, the paint company, mentioned AI like 15 times in its earnings report, which shows how ridiculous it's gotten, because CEOs almost feel like they have to be on this trend. And if you're not saying the right things, you're getting left behind, even though it's like perception versus reality. You know, all these companies could be doing it or not. It doesn't really matter as long as the kind of image is portrayed the right way. So do you see AI still being that central theme, or is there anything else do you think that might pop up through this earnings season?
Well, based on nothing but kind of reading the direction of the wind, I think it's going to be mentioned quite a bit less. It's not going to be as hot a subject for CEOs to talk about. I think it's going to be a big talking point nonetheless. So I think there'll be a cool off in AI. I can't think of anything else that's, let's say, a hotter trend. Can you?
I imagine there isn't really macro conditions that are too severe right now, you know, compared to 2022, where it was very doom and gloom, because that's, unfortunately, perception is more important than reality in this case. There isn't major things people can play on. There's obviously industry specific stuff that will be a factor. I imagine any company with any sort of partnership with OpenAI or NVIDIA will try to drop that, but apart from that, there isn't anything major popping out of me. Okay, more general ones. So for someone who's owned, I'd say, I was writing this question and I wasn't sure if it was hundreds, or would you have approached owning thousands of stocks, over 1,000?
I think so. Well, so we did an analysis in June of, about 3 years ago at the launch of Horizon, which was a look at the 484 stock trades I made over a 20-year period to see the success of my selections, which is there to be seen for, well, subscribers. We should just put it out there, and published every buy I made and what I bought and all the rest. But anyway, I think it was 484 then. So I don't think it's up in the thousands. I would imagine it's around, I'd say we're talking 600 to 700 stock trades, or 600 to 700 buys. And I think it's probably, so that means if I bought Lemonade 4 times, I'm counting that as 4.
Not 1,000, but still plenty of experience here. So from a personal perspective, what is the most value, if any, that you take away from earnings reports and earnings season?
Well, I'm not trying to be reductive, but I buy a stock for an intended 20-year holding period. So I don't get kind of, as some Americans would say, bent out of shape by this week. In fact, I'd prefer if companies switch to a 12-month reporting cycle. Every 12 weeks is farcical, to be honest. In fairness, on the plus side, the latest progress update is never older than 3 months. So as someone in our trade, if you like, the latest storyboard is only a couple of weeks old. And that's very handy for us because we can kind of see the almost exact numbers as they are now, or almost the latest story from the CEO's CEO's desk, as it were. But in reality, I think it's an awful lot of noise. And what happens is outlier stories become very apparent when you look at the market reaction and overreaction. So you can wake up the next day and look at your stock portfolio and see that Acme is up 12% and the other company is down 25%, and very quickly it has been reported to you how the world took the story. But really, I just think it's an awful lot of energy. It's energy sapping. It's very difficult to assimilate the latest quarterly numbers effectively for long-term investing strategy. I've always said, like, put 99% of your effort into understanding a company before you buy it, and spend 1% of the time keeping an eye on it for the next 20 years. Now, that's clearly quite a trivial little throwaway comment, and that's not actually how it goes, but it should be your mindset, because you need to just buy in and go, right, this is like a marriage, and then you keep an eye on it. And I could list off stocks, I won't, but I could list off stocks where in the last few quarters it's been unimpressive, but when I kind of cut to wide shot, I'm still very excited to be a shareholder for the next 10, 15 and 20 years.
Yeah, it's kind of counterintuitive in that we're almost complaining about over transparency because you're cutting through noise. You're cutting through noise there, but we're also keeping these companies honest, you know. And like, I don't know if there's a major shock hiding in wait for 9 months if it was a 12-month cycle, but it also promotes this short-termism and so much noise and flashing red on CNBC when you start turn the TV on. So there's a lot of that.
There is, because when I look at European companies or UK companies, I'm like, these guys, they've told us nothing in 9 months. So I'm like Ozzy Osbourne, who complained when he goes into a restaurant and he's not recognized, he's annoyed. But when people recognize him, he's annoyed. It's like, I want it both ways. It's a funny one. So look, you get what you get, and they both have their upside. They argued upside for reporting once a year is that the management team can focus on what matters, which is the long term. And we all know as human beings, we over-index the short term, we under-index the long term, when in fact it's the long term that should be getting the fury of our attention and our efforts.
And so I'm kind of leading the witness here a small bit, but our listeners, vast majority, are just going to be retail investors. Should earnings season itself be a big preoccupation? Like, as a small individual investor who doesn't have to report to their own investors, the people giving them cash, you're managing your own money. Should this be a big concern?
No, sir. Just focus on long-term plans. Avoid the short-term noise. Don't get stressed out by it. As I said, there are thousands, tens of thousands, probably millions of stock investors out there who have never paid just 1 minute of attention to quarterly reports. Their life is going, they're living their life. They have stocks. They decided I'm going to own these for the next 20, 25 years. And that's the end of their consideration. So it really is coming back to that point I made, is just understand your own personal interest in the sport, as long as you keep your temperament in check.
All right, that's good stuff. And now, to completely counteract what we all just said, we're about to talk about an earnings report, but because they are handy for me and you, for someone who has to talk about the stock market. But the company in question is Netflix. So this is your baby. You've owned shares in Netflix for what, 20 years now?
Just nearly 21 years, yeah.
So over 21 years. So do the math yourselves there and kind of go a bit green with envy if you're listening. But it reported last week. We've always kind of got to talk about Netflix, I feel, when it does report.
But let's just talk about it. So revenue, I have it written down here in front of me. Revenue, Q1 of 2023. So in other words, the same period a year ago, revenue was $8.2 billion. And in the quarter that's just completed, 12 months later, Q1 2024, it was 9.4 billion. So from 8.2 to 9.4 billion, which means revenue grew 15%. And that beat the expectations of the street, which is kind of the name of the game in the short term. Then earnings per share, which is the bottom line profit divided by all the shares in existence. So every share produces a little bit of profit. A year ago was $2.88, and now is $5.28. So the earnings per share grew 83%. And that's a beat. Okay, I'm going to skip the net subscriber additions. and the net cash from operations. In other words, the money that comes in from doing the stuff that you do, 2.2 billion a year ago, up about 2%. So it's like 2.24 billion now. So they're the kind of the main money numbers. But I'd like to just come back to the other part of your question, Mike, which is the net subscriber additions. Because as we said earlier on, every company has its own specific metric that they almost train their listenership or their retail ownership base to watch. And I think the nice thing about the American stock market is that on every quarter, the business has a degree of autonomy to produce the slides that they believe are most pertinent to the ownership's interest, to the owner's interests. So they can produce a nice investor relations deck, which can be misused. They can keep saying, look, over here, when over to the left, there's a fire. But that is a rare enough thing. So my point is that for Netflix, their industry-specific number to this point has been net subscribers or net subscriber additions. So let me go back. So a year ago, in Q1 23, they added 1.8 million subscribers in the quarter. This quarter, the equivalent quarter, they added 9.3 million subscribers, which is a 416% uplift in the number of subscribers. That is just unbelievable. It's just unbelievable. So that's, as I said, it's 5 times the total from a year ago and double what Wall Street analysts had expected, which is a really strong signal that they're cracked down on password sharing and adding an advertising supported subscription tier were a massive success. Because we had a debate in the show about, they're bringing in a lower tariff if you watch ads, and also if you've accidentally left your account logged in your great grandpappy's house, that they're going to slam down on that. Well, they have added, effectively in the last quarter, 750,000 new subscribers per week, in the quarter. Ad membership grew 65% quarter on quarter after rising nearly 70% sequentially in each of the last 2 quarters. However, the plot thickens regarding this company's specific number that we've all, and I've watched for 20 years and picked up the phone and spoke to one of the founders 21 years ago when I got obsessed with finding the next Dell. And I that's another conversation and probably another podcast. But regarding this industry specific number, since time began with Netflix, that's been their number, and they said they intend to stop providing it, and the average revenue generated per member in the quarters to come.
Yeah, so this was the big takeaway everyone had. And we've talked about the quarter in question, and it was a brilliant quarter across all metrics, financial and subscriber numbers. But there's a sense that maybe Netflix is shifting the goalpost now. So I'm going to read out what they said on the call. So, as we noted in previous letters, we focused on revenue and operating margin as our primary financial metrics, and engagement, i.e. time spent, as our best proxy for customer satisfaction. In our early days, when we had little revenue or profit, membership growth was a strong indicator of our future potential. So now it's basically saying we're not judged on that anymore. We've got different tiers, we've got advertising, we have other revenue metrics that don't mean subscriber number is the key to growth anymore. Because for so long it was how many subscribers you have is how much money is coming in. Now that there's so much more facets to the game, they're kind of saying, well, we've been judged on this North Star for so long. For, as you said, you were talking about it 21 years ago. That's not indicative of our overall performance anymore. Now, I feel that that's fair enough, but I also can't help but be a bit cynical in that management is kind of reading the tea leaves. They've seen the impact from the password sharing in particular and riding that kind of wave of it now and seeing like, okay, where's our growth going to come from after that? And maybe that's why they're seeing a stagnation in the future. And that's why, okay, we're going to leave that behind. I don't know. That's my take on it.
Do you know, in '06, I did a master's in business strategy. It was the best thing I ever studied. I've probably said that before, and I just loved it. And at that time, I took a look at this specific phenomenon that we're discussing here about they discuss subscriber growth. And if you think about almost any business with an XY graph, those businesses like Amazon or Netflix or any of the digital giants, Meta, their initial capitalization strategy, the reason they're being given money by venture capitalists is to land grab. So they go out on the y-axis, just get more and more people, more and more eyeballs, more and more viewers, more and more buyers, whatever that one metric is. Just keep pushing, pushing, pushing. Just get out as far as you can on that y-axis for total number of people. Now on the sorry, I've been just moving my hand on the x-axis. If you talk about the bottom line and it's going, the further out you go, the more people you have, the more customers, eyeballs, whatever. That's the one that these businesses, these style of businesses grow at rate. But eventually they have to start to go up the y-axis, which is literally profit and revenue. The reason they're going out on the x is to eventually move up the y. So there was an inevitable point. It was inevitable that they would do this. In '06, I said there's going to be a day where they're going to stop reporting subscriber numbers and start talking money, because they will mature, and there's no doubt there's an absolute army of MBAers in there who've modeled out exactly the point that you just made, and said, right, now is the time to start talking about numbers. I mean, that excerpt that you wrote, it was the CEO, Greg Peters, was it? Was he the one who said that?
Co-CEO, I think, yeah.
Yeah. But he also said that their advertising plan is tied to a higher revenue per member and opposed to fixed revenue per sub, as with relation to the plans with no ads, and basically said that the platform's paid sharing initiative has been hugely successful, but now the thing that matters the most is how retained are these people and how much money are they actually going to pay. But you know what's quite interesting? So we're talking about the death of reporting of subscriber numbers with Netflix, but they are getting into all types of adjacent fields like live programming, such as sports and golf and video games. They've got a strategic partnership with Take-Two, isn't it? Take-Two, Rockstar, the Grand Theft Auto franchise.
Yeah, I think they're bringing GTA to mobile.
So it kind of makes sense to me that, like, for this business to obsess in a world where engagement means your kids have turned into scrolling zombies on a 15-hour TikTok bender, like, this is now a metric that actually matters. Like, we now have seen people are now hypnotized by engagement and how many scrolls does TikTok get from you a day? It has 1,000,001 data points on you before you've used the app for like 20 days or whatever it is. But like, this is the metric now that they're going to start talking about engagement and money in the pot. And I think that that's right for them. I think it's actually quite sensible, to be honest.
Yeah, and I think management probably thought, all right, we saw laugh about 10% after earnings. That's the hit we're very much willing to take.
Oh, I'm telling you, those lads are well used to delivering news that nobody wanted. I mean, our subscriber base grew 5-fold compared to the same quarter a year ago. We're not going to tell you that number anymore. Boo, sell. I mean, come on, give me a break. It's absolutely ridiculous. And they really had a baptismal fire. I don't even remember how many years ago, but the Reed Hastings.
2021, 2022, when subscriber numbers stagnated for like the first time ever. They fell off a cliff.
Yeah, that's right. Yeah. But no, I'm even talking about possibly 12 to 15 years ago. Reed Hastings, founder, was on the cover of Fortune magazine and Time magazine, Entrepreneur of the Year or a Business Person of the Year. I forget which magazine it was. And then months later, they decided they were splitting their service into the DVD postal business was going to be a different company with a different subscription. It was called, I think, Quickster. And people who were paying their $10 a month wanted at that time either a DVD in the post or to have live streaming via the service that we all use now. And there was war. I mean, the stock cliff edged by, I'm going to say it was like 30, 40%. And you know what? They realized they made a huge mistake. So here's what they did. They said, okay, we're undoing that. And it took quite solid kahunas to come out and go, all right, okay, so nobody likes it and you're all canceling. Guess what we're going to do? We're going to undo it. I loved it. So that management team has a really long, it has a long track history of experience and knowing how to deal with things. And for them, I'm sure they knew the minute they said they were going to stop reporting this number, despite its blistering growth, everyone would go, boo, sell, rubbish.
Okay, so we'll finish very easy yes or no question here. I think we all know the answer, but Netflix definitely the eventual winner of the streaming wars. You see the state of HBO Max, Hulu, Disney Plus, all running very unprofitably at the minute.
Yeah, I mean, they've had face melters on the old numbers front, and analysts all over the world and newspapers. I was reading in the LA Times after the report that they were saying, that's it, it's the streaming wars are over. Netflix has won. And as you said, there's this whole HBO 6 Feet Under and Insecure and all that kind of stuff is being licensed over to Netflix, where the other providers are going, okay, if you can't beat them, join them. So I wouldn't be as bold as to say the streaming wars are over. No way. Like that's crazy. But like there's always a David waiting to take down Goliath, and Netflix is now Goliath. But the way I look at it now is it's like a steamroller with ludicrous mode. Like it's just an unbelievable business. And I'm sure those working in Disney Plus and Prime and Hulu and all those other ones are like, oh, that's not fair. We were doing our best.
Okay, before we move on, just a quick reminder from our friends at Vodafone Business. Check out their free one-to-one digital support and advice service today to discuss a range of topics from social media tips, cybersecurity, and even building a website for your business. That's Vodafone V Hub, or just click in the link on our show notes. Okay, big deal or no big deal?
Oh, here, let you do a bit of talking for once. Try. I'm going to hit you with one, Mike. Right, go on. The House passed a bill on Saturday requiring a forced sale or ban of TikTok in the US within a year. And the bill is expected to get through the Senate as soon as this week, and will almost certainly be signed into law by President Biden. So is this a big deal or no big deal?
Yeah, it has to be a big deal. Of course, it's a big deal. Like one of the country's most used apps and platforms is essentially going to get banned. Like it has bipartisan support, so much so that the TikTok bill is actually attached to the big foreign aid bill. So it's an addendum on that, which basically means it has to go through. The only kind of pause I have is that you remember pretty much 4 years to the day Trump in his re-election campaign did the same thing. So we can't overlook the political theater involved in this too. But it is a big deal. We've been through why the ban is in place, and in fairness, considering the amount of control the CCP has over the major companies in China, it's fair enough that the US has concerns that either data will be leaked, or even worse, that the content that so many Americans, particularly young Americans, are consuming might be coerced in a certain fashion. So the common story, I'm not sure how true it is, but the common story is that in TikTok in China, especially for kids, it's all very educational content. Kids are on TikTok where they're looking at how to do their maths homework, whereas in America, it's dance and cartoons or whatever else. So that alone seems quite sinister.
In Ireland, it's Labradors, burgers, pandas, stock market stuff, which that's obviously for me. And then, that's pretty much burgers, pandas, Labradors. It's like if they took away that content, it'd be nothing.
That's very specific to you, Emma, now, just to let you know. But the bill itself outlines that ByteDance, TikTok parent company, will have 9 months to sell its US operations. First off, I don't know if there's a company that has the ability to buy it. Any of the kind of Magnificent Seven.
Yeah, or would want it. I suppose they'd all want it now. Who wouldn't want it once it's clean and green?
Then there are headaches. If you ask Google, Facebook, Apple, Microsoft, and the amount of DOJ and SEC cases that are against them already, do you want to add the headache of a huge social media company aimed at kids, all that? I don't know. Well, Facebook obviously would, but the rest of them, I'm not sure if they would be jumping at the opportunity, and they wouldn't be allowed to. So I'm not sure what goes ahead from here. You remember this time 4 years ago, there was kind of consortiums of investors. I think Larry Ellison was very involved. Oracle wanted to buy certain operations. Microsoft was involved. So I'm not sure how it would happen. Also, ByteDance basically said they don't want to sell it. So I don't know how it goes forward from here. I know it's going to be a complete mess. There is definitely political theater involved, but there's a very real reason why they want it banned too. And I always bring this up as well because when we're talking about social media companies in particular, but tech companies in general, basically none of them are allowed to anyways. Do you know? This isn't like the US throwing the toys out of the pram. It's just mirroring what China are already doing. So yeah, it's a big deal. It seems like it might have a bit more weight than 4 years ago, but we'll see.
Yeah. Okay. It's one to watch for sure. Very interesting. When we see the Meta label sticking off the bottom of our TikTok app, well, let's wait and see.
Yeah, that one I highly doubt, but who knows? Okay, one for you is Cathie Wood's popular ARK funds are sinking fast. Investors have pulled a net 2.2 billion from ARK's active funds this year, topping outflows from all of 2023. Big deal or no biggie?
Well, if you're invested, it's a big deal. I particularly like Cathie and I like ARK. And as you know, I interviewed Brett Winton, their chief futurist here in Stock Club, possibly our longest episode ever. Very, very interesting guy. And Yana Haynes is their former chief strategy officer, and she was on the board of MyWallSt. And I think the world of her. So I'm very fond of the characters in that business, and I believe in their philosophy. But yeah, ARK's funds are so heavily concentrated in just a handful of stocks. Seven businesses make up half of the innovation fund, and Tesla, which is their largest holding, is down 45% this year. Anyway, Wood she's always been buying the dip and reiterated her moonshot 5-year price on Tesla for $2,000 a pop. She only said that on CNBC there about a week and a half ago. And if that happens, I'll be rich, I tells you. But anyway, is it a deal? A big deal or no big deal? I think it's no big deal if you're not invested in ARK, but it's kind of a big deal if you're invested in the companies that ARK is invested in, which is a lot of our listeners and myself. Yeah, look, the tide always turns. There's quality businesses in there, but the fact is there's an exodus from their fund, which is a real pity.
Yeah, I suppose they've also rode the Tesla elevator all the way to the top as well. Do you know what I mean? It goes both ways.
They did. Yeah, this is true.
I've got a really quick, boring elevator pitch that I was looking at this week. Have you heard of a company called Verisign?
I sure have. In fact, I'd say anyone who's used a computer has.
They will, I suppose. They might know they have. But basically, this company's been around since the 90s. Okay, so I've been looking at this company called Verisign. People will know it even if they haven't heard of the name itself. It's been around since the 90s. It's actually, fun fact, sitting below its .com bubble peak. And it's a really unique business. So what it does is it controls the .com and .net top-level domains. So, for example, for MyWallSt.com, we pay in some form of abstraction. We don't pay Verisign directly, but we pay them 10 quid a year to have a .com domain. And in essence, it manages domain names, controls the infrastructure around these registrars, and looks after like key elements like security and maintenance. Domain name system, or DNS, you probably know it more commonly as. So very boring, but very important business. What's magic for investors is that it's got exclusive rights for the .com and .net domains that basically extend into perpetuity. So if it continues to deliver on its contractual obligations, something it's been doing for the past 30 years, it's called this presumptive right of renewal. So the .com contract, for example, is up for renewal in 2024, but unless Verisign completely makes a balls of everything, that will automatically renew for another 6 years. Amazing business, 87% gross margin, 67% operating margin, and 55% net margin. So incredible profit. There is some limitations, obviously. So basically, there's a price cap on what it can increase prices on. So it's about 7% a year. So that caps growth. It forgoes a dividend in favor of just pure buyback policy, which in the past is kind of bitten it a small bit because it's bought at quite expensive valuations, because that's basically where it reinvests so much of its cash. But for a very steady, boring business, Verisign is definitely one to stick on the watch list for we'll say more risk averse investors, especially in the tech space. So that's
a fun fact. I was a shareholder in Verisign. It was definitely one I bought before the dot-com bubble. And interesting you say it's now below its dot-com bubble peak. Okay, granted, 24 years have passed, but like, I don't know, is that something to celebrate? Was it preposterously overvalued and now it's grown into its own shoes?
Oh, essentially, yeah. You look at and we're back to just driving charts, but it's just like on the long-term stock graph is just one massive spike early on, come back down, and then a very steady normal peak. And it isn't this huge grower, and it won't be. Its growth at the top level is quite capped, but it is also a very high floor, if that makes sense. There's not a lot that can go wrong.
Nice. Like it. I'm very familiar with it.
So you got a sneak peek, and then we'll shut up shop for the day.
Oh yeah, our sneak peek or no sneak peek? Well, yes, folks, there is a sneak peek, and there will be forevermore. So you can forget about not getting one. As you know, Mike, I was heavily involved in researching this coming Tuesday's Charging and Fearless, and it's a banger, as we say in the music world. It's a boring industry. It's innovated a production line on a pretty complex piece of tech, not outrageous. It's no NVIDIA, but more importantly, according to their last report, which is actually quite old, but the data within is still relevant, it has a massive order backlog. They just can't make the stuff that they do fast enough. Big pieces of heavy plant that need to get out the door and installed. And I think it's a really interesting business. And that Charging and Fearless stock, along with 51 others in the year ahead, are going to be available. It's a $99 a year service called Invest by MyWallSt. You get 52 stock IDs a year that you and I have researched and debated together. And it's a stock. You know, most of the stocks in Charging and Fearless I'd buy, not all of them, the vast majority. And if I could sell the farm to invest in all of them, if I was let at home to like sell the house, and I would. But you know, that's the whole thing about getting married. The other person keeps you in check. But I love Charging and Fearless, great service.
And that's part of Aaron's. You get Charging and Fearless with Invest, along with a whole host of other bits. But for Invest Plus, you get all that plus our stock of the month as well. So that is available to Stock Club listeners with a €50 discount, $50 discount with Stock Club 50 at checkout. So just all caps, Stock Club 50. Okay, before we finish up, just thank you again to our friends at Vodafone Business. If you're a business owner in need of a leg up when it comes to your digital transformation, get yourself over to Vodafone VHub to book your appointment today. Emmett, thank you very much for joining me, and thank you everyone for listening again this week. That's it. If you can, it does help us out to just leave us a review on whatever podcast platform you listen to us. If it's Apple Podcast, Spotify, quick 5-star, it does help us. So yeah, thank you for joining us, and we will talk to you next week.